What is up, everybody? Welcome back to Bitcoin and Markets. My name is Ansel Lindner. Happy Friday out there. Hope you guys had a great week. We are going to go through a little bit of a Bitcoin pick-me-up today. I do a lot of writing for my own website, bitcoinandmarkets.com, as well as Bitcoin Magazine Pro. And this morning, going through some of the metrics for one of our posts there on Bitcoin Magazine Pro, I started getting bearish, and I am a perma bull. So I know if I'm getting bearish, many of you out there are probably also experiencing that. So we're going to go through a little bit of a pick-me-up for the Bitcoin price, look at the charts, look at some heat maps for Bitcoin, go through yesterday's post that I posted for Bitcoin Magazine Pro, and then just answer your questions. I do have another video, if we get to it, to go through the process, how the current system works in making money, and go through that. So anyway, thank you for joining me. I'm live streaming on YouTube, Rumble, Telegram, which is the community home base, and Twitter at Ansel Lindner. So check me out on all those platforms. If you're watching on Twitter, jump over to those other platforms, and there you can make comments, and I can see your comments, and we can have a discussion. So, okay, let's share the screen and get right into it. Bitcoin and markets.com. That's the website. I'm posting a lot from Bitcoin Magazine over to Bitcoin and Markets, but check that out. You can become a free member over there. You can become a paid member and a professional member to get my premium content. So I appreciate everybody that is subscribed and supports the content. This is Bitcoin Magazine Pro. This was my piece yesterday, and I think we should just go through that first, actually. I don't think they'll have a problem with me going through this. Okay, so there's been a lot of sell pressure out there. People talking about a lot of sell pressure. We have the German government selling. We have the U.S. government selling. We have Mt. Gox and the distributions. You know, writing this yesterday, this was all that people have been talking about all week. But now today, it's like 99% people are talking about the debate last night. So I'm not going to talk about that at all. It definitely went the way I expected. I expect the globalists to lose big time this year in all of the elections around the world this year. And so this was right in line with those predictions. But anyway, so all this selling has kind of been already forgotten about. But this post was about why maybe this is over exaggerated. So the US and German governments have been moving significant amounts of seized Bitcoin to exchanges, signaling their intent to sell. On June 26th, the U.S. government transferred 4,000 Bitcoins to Coinbase Prime, raising concerns about downward price pressure. This transfer represents only a fraction of the government's total holdings of approximately 213,000 Bitcoins, worth over $13 billion. And there's no sign that this sale will be repeated, like they want to sell a total of 40,000 and this is only the first tranche or something. There's no sign of that. This is a graphic of all the different countries and their estimated Bitcoin holdings. You can see the US at the top. It's silly to sell, but this is actually a pretty nice position, just over 1% of total supply. China's up there. We don't know that this is exactly correct, but we assume that they have this 190,000. United Kingdom still at 61,000. Germany selling off from 46. And I think this recent sale pushed them down below Ukraine. So now unofficial Ukraine holdings, 46,000 Bitcoins. So you can see El Salvador coming in with 4 digits as well. So that's what we got. All right. So Germany was selling 750 Bitcoins. The fact that these movements have coincided with the price dip has contributed greatly to bearish sentiment in the market. Yes, yet the amounts moved are still relatively minor compared to the overall daily Bitcoin trading volumes. These types of developments are always accompanied by speculation about motives. Okay, so then I get into some of the motives and why I don't think that it is these countries are trying to force Bitcoin down, the price of Bitcoin down. That's not their goal here for several reasons. First, Hanlon's razor. that never attribute to malice what can be adequately explained by stupidity. Like I said, this is a stupid thing to do to sell your Bitcoins, but they just don't understand what they're doing. Second is this is a relatively small amount of Bitcoin compared to what's been changing hands on a daily basis. For instance, the average spot ETF inflows alone are still at 125 million per day. And yes, we have outflows, consistent outflows, and then consistent inflows, but the average inflow is over the life so far of these ETFs is still 125 million per day. And the total government selling of these reports is 250 million. So about double the daily inflow to the ETFs. And the ETFs, that doesn't include other major flows for companies stacking in their reserves like Tether, MicroStrategy, and Metaplanet, as well as now the Australian ETFs I see are adding, a significant amount every day, 50 or I think $50 million worth or something so far since their launch. That's what they've been adding every day. So there are significant flows out there, and this whole dumping from the governments is not enough really to move the needle. The third reason is that it's not likely to be malicious is liability. Now, this is a little bit of a topic that I'm not well versed in. I'm not like Joe Carlasari, where he's the Bitcoin lawyer or anything, but it definitely brings up questions of liability in my mind. So while rare, there are cases where the government has been sued for market manipulation, where government agencies have been found to have caused market manipulation. So this is like Enron. In the Enron investigations and lawsuits, they found that many of the government agencies were actually at fault for market manipulation. And so there are cases where this kind of stuff has come up. Also, like state governments have been sued for market manipulation and things of that nature. So they are rare, but they have occurred. Generally, it is a very high bar to get past sovereign immunity, but there are ways. Internationally, these cases are much more common, with countries suing via WTO specifically about dumping practices and other international legal frameworks. So there's lots of cases every year about where countries go to the WTO. Hold on one second. Where countries go to the WTO to sue another country about unfair market practices, specifically dumping, and this would be dumping practices of Bitcoin. So there are international ways that maybe there could be some avenues for people for liability. And lastly, the public backlash. So the liability to public perception. And, this is becoming a Bitcoin election in the United States. And does the current administration want to be seen as dumping on people? No pun intended with Biden, but do they want to be seen as manipulating the market for this big voter block that is coming to the forefront? I don't think so. So there's different sorts of liability here that we're talking about, but for all those reasons, we can stack it up to saying that I don't think this is malicious behavior. Okay, what about the Mt. Gox creditors? And I forgot to fix this. It's supposed to be just MT Gox. And I didn't fix that. Oh, maybe the editor put that back in. Okay. Am I wrong? It's not actually Mount like this. It's just MT GOX for Magic the Gathering Online Exchange. And so there should be no period and no space. Hit me up in the comments. Tell me if I'm right or wrong about that. All right. So adding to government selling pressure, Mt. Gox will begin distributing 142,000 Bitcoins to 127,000 creditors next month. So just over one Bitcoin on average per creditor, which is an interesting little tidbit there. While the typical market participant interprets this as massive selling pressure, I and several other analysts predict that the price impact of these distributions will be minor. Alex Thorne has a great thread on the subject. in which he lays out a well-researched case. So I go through his reasons here. Most of the creditors selected for the current dispersion, which is considered an early payout. Can you believe that? It's been 10 years since the Mt. Gox thing. And this first thing is considered the early payout. But you had to, the creditors had to accept this early payout and a haircut of 10%. So this ends up only including 95,000 coins out of the 142,000 that's normally cited. So it's already not half, but what would that be? 65% of that total coins. So much of that will go to claims funds or Bitcoinica BK. This sounds familiar. I know what that is, but it's been so long. I don't know what company this is specifically. So they're going to take a lot of it. And this claims funds, what they did was, it's a group of people that went around and bought the claims from creditors. So let's say Mt. Gox owed you a Bitcoin, and instead of waiting for this 10-year process to happen, these claims funds people would go and say, hey, we'll buy your claim to your Bitcoin off of Mt. Gox, and we'll give you current market price for it. So when market price was 10,000, they say, we'll give you $10,000 for your Bitcoin claim from Mt. Gox. And so they were just collecting all of these claims. All right. So if you take those guys out and Bitcoinica, that only leaves approximately 65,000 to individual creditors. So these are likely diamond-handed early adopters who refused aggressive offers by claims funds over the years in exchange for their dollar value at the time. Also, capital gains tax provide an incentive barrier to selling. So that isn't to say there won't be a percentage of individual creditors dumping, but that number is likely to be much lower than the market is pricing in already. So the market is trying to price this in, and they might be pricing in this amount of dumpage, but it's not that amount of dumpage. It's not even this amount of dumpage. It's not even this amount of dumpage. It's way less. Like we're talking maybe 10,000 Bitcoins, maybe that. And I don't think that's the case. It's probably going to be a couple thousand. Because like they said, they've held out against aggressive offers from claims funds. They're probably diamond-handed early adopters. And so that's that. Oh, and he talks in the thread, Alex Thorne here talks in the thread about these claims funds and how they aren't going to be selling either and why he thinks that. So anyway, all this leads to pressures being overblown. Let's see. I talk about it tends to be the case for Bitcoin that bullish developments are underestimated and bearish news is overestimated. So we talk about pricing in things. Okay. So people talk about, oh, the halving's always priced in. Well, the halving is a bullish development, or at least it should be, because it's a issuance cut. It's a decline in the issuance rate. So it should be a bullish development for the price of Bitcoin. Sorry, I still have a cough. I'm getting over my sickness. All right. So, yeah, the halving should be a bullish development, but it's always underestimated, right? They try to price it in before, and there will be people arguing that the halvings are priced in, but obviously they're not. Okay. Because price every single time after a halving, price goes like in the 100 days after the halving, the price is double where it was at the halving. So obviously it's not priced in. Also, the ETF, we were told the ETF was priced in. Long before it was launched, it was supposedly priced in. Okay. But this is a bullish development, and it's usually underestimated. So they can only price in the estimation or the anticipation or the anticipated demand. They can't price in the actual demand or resulting demand. So I bring in Austrian economics here. I say, Austrian economics teaches you that we don't know what our subjective valuation will be in the future, moment to moment, under different circumstances. So we have this ordinal value system, and at any one time, like let's say we have $1 or $10 now, because inflation, we have to use an example of $10. And you go to a grocery store or you go to any store, and you're like, okay, I want an apple. And so you buy an apple, but maybe you don't know tomorrow you might want something else in the exact same situation. Just a day later, you might want something else. You don't know what your subjective valuations will be in the future, moment to moment, and under different circumstances. They change constantly. You can't even hypothetically talk about them. Like, oh man, if I had $10, I'd spend it on this. Well, maybe you would, but you don't know. You can just speculate about what your valuations will be in the future under different circumstances. So anyway, that's the problem with pricing in, is you can only price in an estimated or anticipated demand. Today, I might say that, okay, I talked about that. So those are dynamics that cannot be priced in, only estimated. So again, bearish news tends to be overestimated and bullish news tends to be underestimated prior to the event itself. What is remarkable is we can see this in the charts. Okay, blah, blah, blah. Above, you can see the daily RSI hitting oversold for the first time since August of 2023. Right here. And in August 2023, that's when SpaceX announced that it sold its Bitcoin. Before that, the daily hit oversold in March of 2023 during the banking crisis. And before that, in November of 2022, during the FTX collapse. So it's big events where the daily hits oversold. I mean, these are big time events. Not even quarterly. I mean, we're going back August, so that would be almost a full year that Bitcoin hasn't been oversold. And before that, so from August back to March, so that's about 6 months. And then back to November, that one's not that far, but these are major events when Bitcoin goes oversold. So far, the bounce has not been all that strong, but the probability of significantly more upside or downside is quite low. And there's that bullish divergence. Then I take a look at August compared to today. Looks very similar, range bound with a hidden bullish divergence on oversold conditions. So that's the big chart from yesterday's post. What else? So I talk here about the strong consolidation of things above the price that are now leading to resistance. And I don't like to see this. This is one of the things that made me bearish this morning. So let me bring up a live chart and go through and add some of these moving averages. So let's add the 128 day. Oh, this thing's jumping around me. 128 day, 100, 50, and 20. And then we'll also add the 20 week in here. And you can see how they're all clustering right around this same level. And usually they support the price, but right now they're going to act as resistance above the price. So that's why I was getting bearish. But we're oversold, and we have some other things to talk about. Let's go to the heat maps. So this is CoinGlass. You guys probably know it. And this is the 3-month look. And you can see this bright area up here. This is a bunch of liquidation levels, about $12 billion worth of liquidations on just Binance, on just this one pair for perpetuals. There's also perpetuals against USD, not USDT. But this is a bunch of liquidity up here above the price, all the way up at the all-time high, 72 to 73,000. If we kind of move in, we look at the month, 1 month. You can see that we're starting to build some of this cascading potential above the price. So we hit this, it'll liquidate people, pushing the price up. Because when you liquidate a short, you have to buy Bitcoin. So it pushes price higher. And same way on going down, when you liquidate longs, they sell the Bitcoin. And so it cascades down. There's not a lot of, you can see on this chart here, there's not a lot of cascading down potential, but there's a lot of cascading up potential. Okay, let's go down to the 1 week. And all these windows they only include positions that were opened up in that window. So this is a 1 week. These are all the positions opened up this week since the beginning of this chart. And you can see we've cleared out the main section down here below 60,000. And now the next biggest one is juicy up here at 62.5. So starting this cascade going higher, we'll see where that ends up. So these are bullish. Let's go back to the 3 month. And again, the gravitational force of this cluster above price is ridiculously strong. Why are you going slow? Look how bright that is. I mean, excuse me. Yeah, you can see this yellow is just very bright. And if you go to other exchanges, Binance is just the biggest one. But if you go to Bybit, you're going to see the same sort of thing. I don't want to have to wait to load every single exchange here, but just show you a couple so you can see that it's the same. So you can see here on Bybit, exact same up here at 72,000 is where all of the liquidation potential is really. Let's go to Deribit, see what that is looking like. I know Binance is still the biggest, but what are the other big perpetual exchanges? I guess BitMEX is still up there. We see if they have a BitMEX one. And see, Deribit is also very bright up here at 72,000. And let's do one more. Let's do BitMEX. See what that's looking like. Good old friend, BitMEX. After this, I'm going to take a look at the comments section. So, I mean, this is a huge amount of volume. And it's all up here at 72. So all the exchanges are agreeing that 72 is the epicenter for the gravitational pull. Okay, let's check it out. Dex Invictus, what's up? Stranger. So can it bounce? LOL. It can bounce. Let's go back to the chart. It can bounce, but any level that we've been watching for a bounce is not there. Has not come to fruition. There's also some other levels above the price, which let's go to this one. Okay, so this is our spreadsheet that we track for Bitcoin Magazine Pro. You can see this is our price section, and it has the spreads over here, and it's below a lot of these important levels, like the 50-day, the 100-day, the weekly B bands middle line. So it's on the bearish side of the B bands for the weekly. It's also at the bottom of the band for the daily, but this is specifically the weekly middle line, which is the 20-week moving average. It's below, it's negative. And then also this one, the short term hodler realized price. And I've talked about this quite a bit in the past. That is negative. So it's under this price is under this level right here. And in the past, this has been a very solid, like, at least way to think about it is that short-term holders are technically weaker hands. So if they start losing money, they're probably going to be more likely to sell and sell the bottom too, but sell in general. And so short-term holder realized price is going to be like a level you want to watch for where the weak hands are. I mean, there's also a possibility that going under realized price makes them less wanting to like lock in losses and sell at that level, but probably not. I think it's more of a weak hands level. However, there's not a lot of retail out there right now. If we look at Google Trends, let me bring that up. Google Trends. And we will do buy Bitcoin. Share this tab. And we're going to go worldwide. Worldwide, baby. Come on. Worldwide. And not past day. We want the past 5 years. So right here. I mean, look at this. This is bear market interest. You know, end of bear market, or the end of the bear market. This is going into the later half of the bear market. We're here at 15 November. I mean, might got some attention from FTX, but you know, we're looking at mid-teens, low 20s, and here we're in the low teens. This is lower than bear market interest for Bitcoin. I mean, we had to go all the way back here to see this bear market to have these 12s and 13s back in 2019. So this is very bad. To me, this means that retail is not there. So bringing this now back to weak hands versus strong hands right here. So weak hands and strong hands. Who is the marginal short-term holder right now? It's more likely it's these ETFs, right? I mean, short-term holders in their definition, and let me just make sure what this is. Where are we going? I think it's a very short period. Now I can't remember though. Short-term holder, realized price. It doesn't say on here, but I think it was 7 days. This is 1 week for realized HODL ratio, but it's a very short period. So the short-term HODL, no, it's actually, now I'm going to have to look this up. Okay, where are we at? All right, I'm going to look into Bitcoin on the short-term holder realized price. And it's 155 days. That's what it was, 155 days. So 155 days, the marginal holder, new holder of Bitcoin is probably going to be these ETFs, not retail, because retail is not even here, as we saw on Google Trends. So what does this tell us about the strength of their holding or their hands? Most likely they are much stronger holders. So this short-term holder realized price probably doesn't have as much impact right now, at least in this part of the market. If we go later into the cycle, say we get towards the end of this year and retail has shown up and we do have another consolidation and we start hitting towards this short-term holder realized price, then I think maybe the weak hands will come into the situation. But right now, I don't see this as being a significant level. But we have been watching this. But yeah, these are some other price metrics. Okay, let me check Telegram and see if you guys have any. Oh, why did I do that? No comments from Telegram. All right. Well, guys, I am live streaming on YouTube, Rumble, Telegram, and Twitter. Check me out on the video platforms, because that way you can comment and I can see your comments. So, all right, let's. What else were we talking about? I can't remember where I was. We're going through all of that. We're going through the price chart. We're going through the heat maps. We're going through the short-term holder realized price. All right. I did get a request earlier, just a few minutes before I went live, to go over the hash rate and stuff. So let's take a look at that. Hash rate is diving, just going way down in the last few days. But if you look at this dip, okay, from after the halving to May 9th or May 10th, this dip is not as drastic. It looks bad, but it's not as drastic. Let's go to the 1 year. And if we put this in the context of the 1 year chart, you can also see that it's not horrible. I mean, yes, it is negative, and usually it's not, but it's fine. It's not like there's some major problem here inherent in this hash rate going down. You know, these miners are not getting destroyed. They can come back on the minute price starts going higher. So if we start cascading higher on these liquidations, excuse me, if we start cascading higher on these liquidations and price recovers rapidly, this will shoot back up as well. So I'm not too concerned about that. All right, let me check the comments one more time, and then I think we're going to watch a video. 126 people watching. What's going on, guys? Check out the links in my pinned tweet on Twitter. If you're watching over there on Twitter, you can find your way over to the website. You can find your way to the Telegram. You can find your way to the YouTube and the Rumble and make a comment. If you guys are watching this later, like, comment, subscribe, hit the notification so you know when I'm going live. I've heard that some people have hit the bell and then it never notifies them, but you know, it's always a good thing to do because I kind of live stream at different times. Some days I live stream, or some weeks I live stream Monday, Wednesday, Friday, sometimes just Monday, Friday. Sometimes I put a Thursday in there if there's going to be like a FOMC meeting or a CPI drop or something like that. But all right, let's watch this video. And I am sharing my audio with Telegram. Let's make sure I'm sharing this audio. I think so. With this tab. All right, here we go.
Step 1. The government creates glorified IOUs.
Okay, so sorry, I keep pausing this. So this is Mike Maloney. You guys probably know him. Big gold, silver bug. I respect his work. I disagree with this video here, but you know, we'll walk through it. Now, if you're finding me for the first time, my content is unique because I have a complete thesis, macro thesis, and it's 3 Ds. It's deflation, deglobalization, and demographics. You can also add Bitcoin in there at the end, but that's my macro thesis. It does not fit with Mike Maloney. So the first part of my macro thesis, deflation, is a way of understanding the current financial system, monetary system, and Mike Maloney doesn't get it. So let's listen. If he did get it, then we would have had hyperinflation by now, because these guys have been talking about hyperinflation for decades, and especially since the Great Financial Crisis and QE started, but it hasn't happened, and it hasn't happened anywhere. Hasn't happened in any major economy. Hasn't happened in Japan. Japan started QE way before the U.S. So these guys have been wrong. Now, instead of questioning their assumptions and going back to square one and reevaluating, no, they just continue on with their same thought process.
These bonds increase our national debt and put the public on the hook to pay it back. Step 2. IOUs are swapped to create currency. The Treasury sells the bonds to the banks. The banks then turn around and sell our national debt at a profit to the Federal Reserve, which they probably own.
Okay, so what step did he miss? He already missed something. And he did it on purpose. I mean, he knows that he left it out. Any ideas? Let me see in the comments. Any ideas? Well, what he left out was the bankers paid for it. So the Treasury issues IOU and the banks pay for it. Primary dealers specifically, they pay for it. And where do they get it from? They get it from their clients. They get it from money market funds. They get it from other things. So they give money to the government. There's nothing in this. So the Treasury just gives them the certificate to the banks. No, the government does not just give away IOUs. They have to get the money in exchange. So these guys pay for it first. All right. What's up, Dex? Yeah, watch party.
The Federal Reserve then opens its checkbook that doesn't have a penny in it and buys those IOUs with IOUs that it writes, checks, on a checking account that has a zero balance. Then they give those checks to the banks and currency just springs into existence. And then the whole process repeats.
Okay. No, the Federal Reserve does not create money to buy, like this, he's talking about QE right here, where they are purchasing assets. They don't purchase assets with money. They purchase assets with reserves, and reserves are not money. It would be kind of like, okay, I get a lot of pushback on this specific point, but let's just say, go back 500 years something or 1,000 years, and you have coin money, and people are using gold, silver coins, copper coins, and that's money. All right. But now somebody tries to sell you something and they say, well, I'm not going to give you money. What I'm going to do here is behind my counter where I'm selling my goods from, I'm just going to put a mark next to your name. Okay. That's what I'm going to do. I'm just going to put a mark next to your name. So they're adding reserve. The Federal Reserve is adding reserves, but it's not money. They're not actually giving the person money. They're not giving the banks money. So this is wrong. And he says money just poofs into existence. Well, no, it doesn't happen there. Okay. It happens in a different part that we're not even at yet. But this has nothing to do with money creation. This whole process that he's talking about right here has nothing to do with money creation. All right, let's continue.
This results in a buildup of bonds at the Federal Reserve and currency at the Treasury, which is really just a supply of numbers. The Treasury then deposits the numbers in the various branches of the government, and we get to step 3. The government spends the numbers on promises.
Okay, the Treasury's money is held at the Federal Reserve. So this graphic doesn't even make any sense. They have a Treasury general account, and that is with the Federal Reserve. Okay, then the Federal Reserve lets them spend it out to the government or whatever, other branches. So that is another thing that's wrong with this.
Public works, social programs, and war. Then the government employees, contractors, and soldiers deposit their pay into the banks. And we get to step 4, where the banks multiply the numbers by magically inventing more IOUs through fractional reserve lending, where they steal a portion of everyone's deposit and lend it out. That currency gets redeposited, and then a portion is stolen again.
Okay, this process doesn't happen today. This process only happens with like backed money, like commodity backed money, because you have like 10% of the commodity in the reserve. And, so it's 90% fractional reserve. But this doesn't happen with credit money we have today. There is no reserve requirement. They can, this guy, Werner, I can't remember what his first name is. Eric, it's not Eric Werner, is it? Eric Werner? He did an experiment where, first off, he coined the term quantitative easing, but he did an experiment where he went to a bank and he made a loan, or he got a loan of $100,000 or 100,000 euros. And he wanted to see what happened on the back end to the bank. Like, where did they go? Did they go and check their reserves? Did they check what that $100,000 would do to their balance sheet? Would it make them actually go insolvent, or did they couldn't give the $100,000 loan? They can only give 50 because that's all the room that they had for their, their reserve requirements. No, they didn't do any of that. All they did was put the money in his account. It poofed out of nowhere. So this step 4 does not exist like he's talking about. This step 4 actually should be private banks making private loans, and that is what creates all the money. And it also has to include the shadow banking system, which he doesn't even have on here, because there's a difference between a banker at your neighborhood credit union making you a loan. That creates money. That is creating money. Or even a big bank, and you have a credit card, and I don't know, with the $25,000 limit, and you max out your credit card. That loan as well is printing of money. But it's also big banks lending to big banks. That's creating of money. Or lending to governments, or anything like that. Lending to major international conglomerates. That is money creation as well. That is where the main money creation happens. It's probably a Pareto distribution or an ultra Pareto distribution, where most of the money creation is happening with these very few, very large entities. And the common person going and getting a loan at a bank is a very small amount of the actual money creation. And that's all happening in the shadow banking system. Okay, so he doesn't even have anything about the shadow banking system, anything about that system at all. He's talking about fractional reserve, which is about 100 years out of date. So, okay, let's continue.
And the process repeats over and over, magnifying the currency supply exponentially. Then we work for some of those numbers, which brings us to step 5, where our numbers are taxed. We pay tax to the IRS, who then turns our numbers over to the Treasury, so the Treasury can pay the principal plus the interest on bonds that were purchased by the Federal Reserve with a check from nothing. Then we get to step 6, the debt ceiling delusion.
What? Okay, let me rewind this.
Our numbers are taxed. We pay tax to the IRS, who then turns our numbers over to the Treasury, so the Treasury can pay the principal plus the interest on bonds that were purchased by the Federal Reserve with a check from nothing. Then we get to step 6, the debt ceiling delusion. The system is designed to require ever-increasing levels of debt and will eventually collapse under its own weight because politicians always kick the can down the road. They don't want it to collapse on their watch.
Okay. Yes, it is an ever-increasing system, but it is an ever-increasing system with diminishing marginal returns. We talked about this. Was it last Friday we talked about this? That's the diminishing marginal returns piece is what locks in the inevitability of a collapse in a credit collapse. Yeah, you can kick it down the road for 50 years. And in the meantime, you're going to get, at the beginning of that 50 years, you'll get high inflation or high levels of price rises. And then towards the end, the price rises won't be nearly as high. But you'll have less and less return on the new credit, and it eventually pops. So that is what keeps a lid on this whole system. Not the politicians. I mean, I shared that in Telegram too. The one scene from The Big Short that just really everyone needs to remember, and that's when Brad Pitt's character, and the guys are partying after they just shorted the market, and he's like, "You bet against the American economy. If you win, that means there's going to be a recession, and in a recession, that people die, people lose their jobs, people lose everything." And you're cheering about that. So, and he said that every percent the unemployment rate goes up, 40,000 people die. So nobody wants that. Nobody wants that. Ask the staunchest Ron Paul libertarian if they want that. Do they want to pop the bubble and cause 500,000 people to die? They would say, no, let's not pop that bubble. Let's kick the can down the road. And they're going to kick it down the road until they can't. That's the situation. All right, let's keep listening. What do you have to say?
And finally, step 7. The secret owners take their cut. The world's largest banks own the Federal Reserve. Those banks make a profit selling our national debt to the Fed. They make a profit when the Fed pays them interest on the reserves held at the Fed, and the Fed pays them a 6% dividend on their ownership of the Fed. This system is fundamentally evil. It funnels wealth from the working population to the government and the banking sector.
Okay, so that's a moral claim. He said this system is fundamentally evil because of the way he has it set up. And I just told you that it's not right. So if you, let me go back here. So if you make step 4 the actual center of this whole system, not these bankers, not the Federal Reserve, not the government, they're not in control. They can't stop it if it's going to collapse. That's why I always say that the Fed losing is not runaway inflation. The Fed losing is runaway deflation. That's what, so these guys are not in charge. Who's in charge is step 4. Okay. Who makes these banks lend the money? Nobody. They just do it because, they're the capital allocators. They think they can make a little bit of money off of it. So if you frame it as the bottom in charge, then it becomes evil. If you frame it at the top is in charge, it becomes morally neutral. That people are just using the system because it works. And when it stops working, they're going to start using another system. And that system is probably going to be Bitcoin. So this is a neutral thing. We arrived at this place we are in, not because of the bottom of this diagram. We arrived at the place we're in because of the top of this diagram. Because it works. Everybody wants inflation, not just the government, not just the government people. Everybody wants inflation. Because what does inflation do? It makes you feel good. It's a sugar rush to the economy. Everybody wants inflation. There will be inflation if there can be inflation. Now, see, the thing about a commodity money is that it limits that, right? Because it exposes fractional reserve, exposes insolvency much more easily than a credit-based system. But a credit-based system can't work in a low trust society. You have to have a high trust society. You have to have a high trust international situation, international environment, a high trust for the credit system to work based on credit money. So when that trust starts breaking down, you can no longer have credit-based money. You have to go back to commodity money because it instantiates the trust in itself. So this step 4, the banks will naturally go back to commodity money. They naturally will, because the credit-based money won't work anymore. So again, it's not a moral argument. And I really dislike when gold bugs and people make it a moral argument. I mean, he's a salesman. He's selling his books. He's selling his services for his gold and silver company, whatever. But they're making this a moral argument, and it's based on a wrong set of assumptions, a wrong understanding of the system. It is not a moral argument. It is a natural process. It's like the sun rising every day is not a moral thing. The trees grow, the grass is green. These are natural things. They're not good or evil. They are just themselves. That is what the monetary system is. I mean, yes, there are places in the world like that have smaller currencies that can impose a complete fiat system and destroy their money and really have bad rules and stuff. But on the international stage, that is not possible. That is not possible. That's why they used gold and silver, because it was a way that you could do international trade in a system that had low trust. So, I mean, I'm just thinking also about like Szabo and stuff, and about how he talked about the evolution of money and that it instantiates trust in people, and it has to be a certain, like, verifiable, hard to counterfeit, but easy to verify, or hard to produce, easy to verify. Those are the natural properties that instantiate trust, that make good money in the long term. So it's a neutral thing. Okay, so I beat that dead horse.
It funnels wealth from the working population to the government and the banking sector. It is the cause of the artificial booms and busts of modern economies, and it causes great disparity of wealth between the rich and the working class. And it is only possible because we no longer use real money, we use currency. But worst of all,
no, I mean, there are booms and busts with gold and silver.
It is a form of enslavement. Bond is the root word of bondage. Whenever a government issues a bond, it is a promise to make us pay tax in the future. Nobody asked you if you wanted to pay tax today for the prosperity we all enjoyed in the last century. Nobody is asking our children if they want to work hard in the future to pay for the prosperity we're enjoying now. George Washington once wrote to James Madison, "No generation has the right to contract debts greater than can be paid off during the course of its own existence." By stealing prosperity from tomorrow so we can spend it today, we enslave ourselves and future generations.
Okay, and this was one of the contradictions. So if we just poof it out of nowhere, right, like he was saying back in his 12-step diagram there, if the Federal Reserve just poofs it out of nowhere and the government just creates these IOUs out of nowhere, what's stopping them from just papering over, from not paying those debts, from having a debt jubilee or something like that? So, his argument is not internally consistent. If the government is in control, then they can fix it. If the Fed is in control, they can fix it. The thing is, they aren't in control, so they can't fix it. Okay? Then you take the moral judgment out of it. Yeah, there are bad things that come from the system. There's bad things that come from every system. But you put a moral claim out there, where you built this whole moral justification for your beliefs in gold and silver. And there is no moral justification.
Now, this all sounds pretty bad, but there is great hope. For you are the greatest threat to this false monetary system. This system relies on the public being ignorant of its workings. Please share this knowledge with everyone you know, because an informed public that fully understands the system can build a better future for generations to come.
Okay, that's it. All right, guys, I'm going to take a look at the comments and see what if you guys are saying anything in the comments here. Nothing from the other platforms. Let me check Telegram. Oh, yeah, here we go. Richard Werner. Yes, thank you, Joachim. Richard Werner. No, he's not MMT guy. I don't think so. He is, well, he's worked in Japan for a long time, and he's originally from Germany. I don't think he's an MMT guy, but he wrote The Princes of Yen, I believe is the book. But yeah, that's right. That's the right guy I'm thinking about. All right. If you guys are watching on Twitter, what's up? Go over to YouTube, Rumble, or Telegram. Like, comment, subscribe. That's it. Check out bitcoinandmarkets.com. And have you guys a great weekend. Spend time with friends and family. Get out in the sunshine. I'm feeling under the weather. I need to go have a sunny weekend and spend some time outside and doing some yard work and stuff like that. I think that'll make me feel better. But okay, guys, thanks for hanging out. I'll see you on the next one. Bye.